Good afternoon, ladies and gentlemen. We warmly welcome you to the webinar under the title Impact of the Budget 2024. Today, we are diving into the financial landscape of Sri Lanka, exploring what the eagerly awaited budget of 2024 has in store for us. The budget of 2024 has undeniably been in the buzz in financial corridors, sparking discussions and capturing the attention of investors and the business community alike for the past few months. This budget has stirred reactions with potential impacts on companies, both good and not so good. Today, we are here to dissect those ups and downs, taking a closer look at how the budget of 2024 might influence businesses. So without further ado, I invite Assistant Manager of First Capital Research, Vinodini Rajapupati, to guide us through a voyage of insights, exploring the revenue projections, dissecting the expenditure breakdown, and delving into the strategic blueprints that will shape the nation's public investments. Vinodini, over to you.
Good afternoon, everyone, and welcome to our webinar on the 2024 budget review. Let me share my screen. So just to give a small summary on today's webinar, we will delve into the comprehensive analysis of the 2024 Sri Lanka budget. And before I begin, I would like to state that budgets aren't just numbers. They are the punctuation marks in our nation's financial narrative, shaping the next chapter in our economic tale. Moving on, the government is expecting a budget deficit in 2024. This is because they are expecting to incur an expenditure of nearly LKR 7 trillion, but a revenue of LKR 4.1 trillion, which is a deficit of LKR 2.9 trillion with bank recapitalization, but a deficit of LKR 2.4 trillion without bank recapitalization. So the government expects a revenue of LKR 4.1 trillion, which constitutes 13.1% of the GDP in 2024. The revenue is targeted to go up by about 50%, and we feel that this is possible with the recovery of the economy and easing of the trade restrictions. Moving on that front, there is we can see that the revenue is targeted to go up by about 50%, and we feel that it is possible with the recovery of the economy and, as I said, with the easing of trade restrictions. On that front, there is a tax increase of VAT coming from 15% to 18% and a mandatory provision that requires people to register for taxation, which may help to achieve that revenue. So the total revenue expected by the government will majorly come from taxes, which may contribute 92.6% of this revenue. It should be noted that taxes on goods and services continue to be the leading contributor to tax revenue, making up 59% of tax revenue and 54% of total revenue and grants. Non-tax revenue is forecasted at 7% of the expected government revenue and grants. 2024 total expenditure is expected to reach LKR 7 trillion, representing 22.2% of the GDP, with recurrent expenditure accounting for 75.6% of the total. Within this, interest, subsidies, and transfers are anticipated as the most significant components of recurrent expenditure, constituting 50.2% and 21.9% respectively. On the expenditure front, the government is expecting an expenditure of LKR 7 trillion and laying out the medium-term macro physical framework. The government remains committed to the goals set with the IMF, aiming to increase revenue to 15% of GDP by 2025 and target a primary surplus exceeding 2% of GDP by the same year. The government foresees to achieve the revenue targets by increasing VAT and broad basing revenue collection. However, the expenditure will rise steeply due to salary increments and extensive spending by the government on development activities, reaching a high budget deficit. In this table here, we can see the salaries are increasing as government employees are across the board are expected to receive a 10,000 rupees increment in their salary. However, the biggest concern here is the capital expenditure. If you look at this column, there is capital expenditure and net lending. We can see that it has been increased to LKR 1.7 trillion from LKR 782 billion. So basically, it is increasing by about 2.1 to 2.2 times. That's where the biggest budget deficit concern is coming from. Moving on. So the bigger spending component by the government comes from initiatives to increase social protection, promoting a knowledge-based economy, and a healthier society. So moving on to the IMF targets versus the budget deficit, which is the key component here, we can see that the revenue target set by the IMF for 2024 is up at 13.3%. And on the expenditure side, we can see that the expenditure target is up at 19.7%. It should be noted that the estimated budget deficit for 2024, which stands at 7.6% of the GDP, is well above the IMF directed deficit of 6.4%. And the capital expenditure is expected by the IMF to be at 4.3% of the GDP. Therefore, we can derive from this that the proposed budget is partly in line with the targets set by the IMF. So the budget has several impacts on the capital market front. It has been proposed to allocate LKR 3 trillion for the implementation of foreign debt restructuring and settlement of ISBs under foreign debt restructuring, and LKR 450 billion is to be allocated to facilitate the banking system's capital improvement process. To finance the recapitalization and external debt restructuring efforts, the President has recommended an adjustment of the debt ceiling from the current LKR 3.9 trillion to LKR 7.4 trillion. Moving on, also in the 2024 budget, investors are finding reassurance as the long-anticipated capital gains tax on banks and primary dealers is notably absent. This omission is anticipated to provide an extra boost to investor confidence, especially in the wake of improved earnings, further contributing to positive investor sentiment in the upcoming period. Moving on, now I will discuss some of the significant budgetary moves taken by the government and the impact on certain counters. So as we can see here, on the consumer sector front, 3 proposals were introduced which has a positive impact on the consumer sector, which includes counters such as CCS, Lion, and Haley's. There has been a proposal to increase cost of living allowance for public sector workers by LKR 10,000. And there has been a proposal to increase the monthly cost of living allowance of public pensioners to LKR 6,025 by LKR 2,500. This increase will be implemented from April 2024. Also, the spending on Asvesuma program has been increased to LKR 183 billion, which will provide relief for 2 million families. There has been a proposal to increase the monthly allowance by LKR 2,500 to LKR 5,000 for persons with disabilities and kidney patients. The present monthly payment of LKR 2,000 for elderly citizens will also be proposed to be increased to LKR 3000. However, one of these proposals has a negative impact on the consumer sector counter, as the disposable income is expected to be reduced as a result of higher deductions for pensioners. There has been a proposal to revise the deduction percentage from the salary for the pension contribution to 8% for all service categories from April 2024 onwards. Moving on to the construction sector, the budgetary moves that has been taken by the government has a completely positive impact on the construction sector. Now let's look at the proposals. So one of these proposals is to increase the capital expenditure to LKR 1,260 billion for development activities. There has been a proposal to allocate LKR 10 billion for the renovation of rural roads as well. And there has been a proposal to allocate LKR 2,000 million to rehabilitate damaged rural roads and bridges which have been damaged due to floods and landslides. The government has also proposed to prioritize drinking water projects when allocating the decentralized budget and obtaining foreign loans. There has been a proposal to allocate land to construction companies to construct buildings according to the plans of the respective government agencies. And also, the second phase of the Central Expressway, the section from Kadawatha to Mirigama, will be started jointly with China. Sri Lanka hopes to get the support of Japan for the construction of the section from Kurunegala to Galagedara. Moving on, the government has also proposed to allocate LKR 2,000 million to meet the needs of resettling people in north and eastern provinces. And it has also been proposed to allocate LKR 500 million as an additional provision to speed up the housing program. Also, it has been proposed to provide LKR 500 million for the development of Punarine city, which is a top tourist destination in Sri Lanka. It has been also proposed to allocate LKR 500 million for the construction of the Galle District Auditorium. There has been a proposal to establish an economic center in Bandara Vella, and there has been a proposal to allocate LKR 250 million for this purpose. So this will have impact on the construction sector counters and material sectors as well, including on companies such as Access Engineering, Tokyo, and Alumix. Moving on to the tourism sector, this budgetary moves taken by the government has a mixed impact. It has a positive impact and as well as a negative impact. So let's look at some of these proposals. One proposal is to allocate LKR 100 million to establish wellness centers in tourist hotels and resorts. This will attract more tourist arrivals as Ayurveda plays a great role in health tourism. Also, it has been proposed to allocate LKR 100 million to make the country as a top tourist destination. It is also expected to establish a Sri Lankan Buddhist museum, and it has been proposed to allocate LKR 200 million for this purpose. Also, an amount of LKR 750 million is allocated for the development of provincial councils, provincial tourism board related infrastructure. Also, a provision of LKR 1 billion is given for tourism development. However, a proposal of LKR 600 million is allocated to prepare a program to attract local and foreign tourists. This might cause a negative impact through increased competition, as this amount will be used to modernize the government resorts and will be used to promote tourism as well. The budgetary move on the banking sector now. So for the implementation of foreign debt restructuring and settlement of ISBs under foreign debt restructuring, it has been proposed to allocate LKR 3,000 billion through the budget. This will negatively impact banks holding sovereign bonds. Also, it has been proposed to allocate LKR 450 billion to support the capital improvement process in the banking system. This will help. This will support the banks to recapitalize their capital buffers. Also, it has been proposed to eliminate non-tariff import taxes, which will support import businesses amidst limited tax burden, while also helping banks to improve their fee and commission income. The budgetary move will also have an impact on the agricultural sector. So it has been proposed to allocate 300,000 acres from other government lands, which will have a positive impact for the overall plantation sector as there is a possibility for expansion. It has been also proposed to allocate LKR 250 million for preliminary activities of Pali Aru water project, which may support agricultural activities and also increase the pipeline in the construction sector. Now, on the FMB side, the budgetary move, so there has been a proposal to implement a refinance loan scheme to meet the financial needs of those engaged in the dairy value chain. This will resolve the working capital requirements in the FMB sector, and it will also provide fundings to expand the production there. Also, it has been proposed to implement a special program to increase milk production by 53% in 5 years with the contribution of the private sector. So this will also resolve the working capital requirements in the FMB sector. Also, a new excise licensing system will be introduced in the liquor industry where it will impact counters such as lions, mills, distilleries, and brew. And it also will positively impact the liquor industry as it will discourage the illicit sale of liquor, and will also maintain the industry discipline. Also, it has been proposed to increase the excise license fee, which will possibly increase prices in the liquor industry. Moving on, it has been so right now provincial councils can only permit factories with a capital investment of less than LKR 4 million and less than 50 permanent employees. These provisions will be cancelled and the annual turnover limit will be increased to LKR 600 million. So this will have a positive impact on all the counters targeting expansions. Also, the construction of the Hingurangada International Airport has not been implemented as yet. Therefore, for its basic activities, the government has proposed to allocate LKR 2 billion. This will positively impact the transportation, construction, and the tourism sector, as it will boost air travel, both domestically and internationally. And also the airport could facilitate improved connectivity, making the region more accessible to travelers, and will also boost Sri Lanka's tourism and trade, while also improving the construction sector activities. Moving on to the next proposal, LKR 1.5 billion will be allocated for the development of the access roads of the proposed Kandy Multi-Transport Center project, and LKR 200 million will be allocated to set up a large city base on the station premises of Mihintali. This will make processes more efficient and will expand the activities in the transportation sector, while it will also attract tourists due to improved transportation and access. Also, the government has plans to develop Trincomalee as a major economic center of Sri Lanka, with large-scale agricultural programs and a coastal tourism zone. This will positively impact the tourism sector, agricultural sector, and the logistics as well, as it will expand port infrastructure and facilitate increased trade and economic growth. Also, large-scale agricultural programs will expand the agricultural sector in Sri Lanka. Also, the creation of a coastal tourism zone will support the tourism sector. Also, a common program will be implemented for the development of gemstones, which will positively impact the gem sector, which includes counters such as blue and radiant gems, as it will help to boost exports and increase revenue through gem sales. There has been a proposal to increase the borrowing limit from LKR 3,900 billion to LKR 7,350 billion. This will impact the treasury counters, which will witness an mixed impact. Moving on to the other proposals. So 20% of the shares of the two large state-owned banks in Sri Lanka is proposed to be given to the strategic investors or the public to improve capital and support the future growth of the two state-owned banks to reduce the taxpayers' burden. So this will build financial sector stability and will also enable cost savings to the government. There has been a proposal to establish a new revenue authority as well, which will support a fast-track tax administration while expanding the tax base. Also, it is mandatory for the submission of a copy of the certificate of the taxpayer identification number, which will be a mandatory requirement to open a bank current account at any bank, obtain approval for a building plan by the applicant, register a motor vehicle or renew license by the owner, and to register a land or title to a land by the buyer. This will widen the tax base and it will negatively impact the consumers as the disposable income of individual will be affected and also the consumer expenditure in the country will reduce. Also, there has been a proposal to increase the VAT rate to 18% with effect from January 2024, which will again impact consumers' purchasing power. Yes, so now we come to the end of this presentation and now we are opening the floor for the Q&A session. Please drop your questions and we'll make sure to answer as much as possible. Thank you.
Thank you, Vinodini, for a precise and insightful presentation. So as Vinodini said, now we're moving on to the Q&A session. And to join us with the Q&A, we have Mr. Dimant Matthew, the Chief Research and Strategy Officer, and Mr. Ranjan Ranatunga, Assistant Vice President of First Capital Research, along with Vinodini. We will give our audience 5 minutes to type in your questions in the Q&A section box, and your questions will be taken up thereafter.
Thanks a lot, Saima. Could you help me switch on my video, please? Yeah.
Yeah, sure. You should be able to switch on.
Okay, thanks. Right. So until we get some questions, I think we have some questions that we've already. Oh yeah, we have some questions that we've already got. Let me try and answer some of the questions. Ranjan, Vinodini, you can also drop in. So one question is on the let me first give you all the overall impact from the budget and what we think, a summary basically. So if you look at the overall picture, so what we think is that there seems to be a lot more consistency from last time to this time, so that there doesn't seem to be any changes. So not a lot of nothing much has been done in terms of the revenue side, because so that is good to maintain consistency. And yes, there's a spike in the budget in terms of revenue that has been mentioned, but we think unlike last few years, this year the revenue target I think is much more achievable, because on one side we're starting from a lower base. Then we are looking at a recovery of the economy. Then again, we're also looking at the trade restrictions completely getting lifted. And then finally, also we're looking at some amount of acceleration in economic growth, some amount of stability coming into the system with lower interest rates, and also end of the restructuring possibly by the end of the year. So all that is like to push up business activity and also improve government revenue. However, the cost side is a problematic factor. I think Vinodini also hopped on it slightly. So uh, the overall salary increase per se is not the bigger issue, because there you only see about 156 billion of increase coming into the government. That is not too much of a problem, because there also it has been strategically put in where the cost of living allowance is what is raised, not the basic salary. So with that, what happens is there is a limitation of increasing subsequent increases coming in. However, the bigger issue, I think, lies in the capital expenditure amount. So it could be a development budget targeting the elections as well. So, however, the issue is the capital expenditure has been raised from last year's or current year's somewhere close to estimated 700 billion to 1.7 billion, so somewhere around 2.1 times, 2.2 times. So there are, can the government fund this kind of a massive infrastructure drive or development drive? And then that shoots up the budget deficit again. So if you exclude the bank recapitalization, yes, budget deficit is expected to come down, but still 7.6% seems to be still onto the high side. So that we think is a problem in this budget. But on the positive side, the main thing is that the consistency has been maintained. Yeah. So I think we have a number of questions that has been put in. I think it's better to get to those first. So I think the first question comes up, will treasury bills or bond rates move up? So let me answer that question. That's a difficult thing to say. So at this moment of time, what we think is, if we can get through the debt restructuring, and let's say some amount of SOE sales also comes in as planned in the first quarter, right? That could actually bring in some money into the economy. So on one side, costs get cut because of the restructuring. On the other side, you have some dollar inflows coming in. So we feel that that could actually bring down policy rates. However, beyond the first half, there could be some pressure that comes in on one side because of possibly some uncertainty. If, as explained, there is going to be a significant amount of debt raised or expenditure, either some way, either through debt or printed money component, then we are bound to see some inflation and also some a rise in interest rates, specifically in the second half of the year. So yeah, let us move into the other questions that are there. Yeah, implications on investments in treasury bills, implications coming out of the budget. Yeah, Ranjan, would you like to take that up?
Yeah, thank you, Dimantha. So regarding the implications, on the budget side, we didn't hear anything much on the treasury bills and bonds, but there is the government from the budget has given a guidance saying that they're going to raise up the finance ceiling to 7.4 trillion. So there's a bit of uncertainty around that regarding the raising of funding, but our thought process is that what the government will look at is given that the rates are expected to come down in the near future, they will possibly look at raising short tenure debt in the shorter run, while with the CBSL continuous guidance on with the CBS guidance on bringing down the rates with the inflation target of 5% in mind. So what we're expecting is right now there is nothing much implications on the T-bill investments from the budget right now, but we may see a bit of money being raised in terms of up in the financing corridor. So yeah, so anything to add on that, Dimantha?
No, I think so. As such, there's no real implications on specifically on treasury bills or bonds. I think there's no problem in terms of investing in these instruments. We've completed a domestic debt restructuring. Rates are pretty attractive around the 15% mark, I should say. So I think there's a potential decline in interest rates in the near future. So possibly, especially if external debt restructuring also finishes and some confidence comes into the economy. So I think there's no problems at the moment in terms of investing in the economy. So let us go into the next question. I would like Vinodini to take it up. I think they are asking to explain again the effect on the impact from the salary increase, how it affects possibly sectors or how it affects the economy as such. So Vinodini, if you can take that up.
Sure, Dimantha. So apparently, they are planning to increase the salary allowance of government sector workers by 10,000 rupees. So this will, there are around 1.3 million government servants. So this will surely increase the disposable income of majority of the population in Sri Lanka, and this can impact the consumer sector counters, where we can see counters such as CCS, Lion, Haley's, Hemas, Sunshine Holdings to be impacted positively, where their earnings can also push up in the near future.
Yeah. Thanks a lot, Vinodini. So yes, basically the consumer side, there could be a positive trend because of that, and also mind you, there's a large amount of government sector servants and 1.3 million, and that may also push the private sector also into salary increases. So we are anyway expecting December and March for wages to increase, and this time the wage hike is likely to be a real wage increase above the inflation levels, especially in the private sector, so which could push the consumer side. So going into the next question, what is the purpose of increasing government debt by 200%? This is to establish the limit to the total of existing debt and raise new long-term debt via DDR. I think partly Ranjan explained this. Ranjan, you want to elaborate a bit more on the raising of the debt ceiling?
Yes. So, as highlighted in the budget, we saw that they're going to raise the debt ceiling from the current 3.9 trillion to 7.4 trillion. And what our belief is that so the main reason for the increase in debt ceiling will be to support the restructuring operations that will be happening in terms of external debt, as well as to fund the recapitalization need. So with these in mind, how our outlook goes as we explained before, with the outlook of reducing interest rates in the near future, we may see bit of bill activity come into play, because government may want to raise funding on a shorter tenure basis with the outlook with the target of reducing rates in the future. So with that, on that note, what we are so going forward, we will see. However, on something of a concern is how the debt ceiling will impact the debt to public debt to GDP ratio of the government and meeting the IMF targets. So that will be something to keep in mind, because with this object with high capital expenditure in card for next year, as well as external debt restructuring and all, we may see borrowing coming near debt ceiling limits, and also there are few bills and bonds maturing with the interest due as well. So that may also incur a bit of pressure on the government side to raise debt. So as again highlighting something to keep in mind on this going forward will be how we going to meet the IMF target of debt to GDP of bringing down that threshold to 95% by 2030.
Yeah, thanks, Ranjan. So some things to note there. Why the government is increasing the debt ceiling? It could be to raise more short-term debt, or it could be to fund or basically the treasury bill ceiling has come to the threshold, so there could be more short-term that they want to raise because the rates are high. It could be because of more closer to the election, they may want to do some more development activities and want to raise more debt. In that case, that it could be a risk for rising interest rates and possibly inflation as well. So a lot of things to keep in mind. Also, it's not technically a DDR, but a EDR. To facilitate a EDR also, there could be this raising of the debt ceiling could have been put in. So basically EDR means the external debt restructuring. So there could be multiple ways. They may have maybe looking at different options in terms of conversion of bonds as well. So possibly it keeps a lot of things open in this kind of a scenario. Yeah. So the next question is how the BOT arrangement introduced by the government to construction sector affect to their operations going forward. So BOT means build, operate, and transfer. If I take that up, basically, it's a good option for the construction companies, but then something to note is that the construction companies are under a lot of stress at the moment. Do they have the sufficient working capital to take on these kind of projects is a question, but possibly for the larger companies, maybe companies such as Access, maybe companies such as Maga, maybe may look at taking on projects such as this. So it gives some or the construction sector some amount of flexibility and also you could say an opportunity if you really want to grow. But the question lies is that do they have the sufficient working capital to take on such a large project in this nature? Yeah. So,
Dimant, sorry, something small to add to what Dimanta said.
sure.
So with this, so this is the first time that we are seeing the built operation transfer models come into play in Sri Lanka. So, however, something to note is that there are a few positives regarding this because so what we saw was that during the last few years, the construction sector has been tied with a lot of money that is outstanding by the government. So this can be something of a solution that the government has brought forward to reduce their capital expenditure going forward. And something to note is that this will also help the construction companies to unlock their working capital and other requirements which are tied up with banks right now. So if you look at the banking sector, about more than 25% of the construction sector loans have gone to the stage 3 NPLs. So with this size, something like this of a solution, we may see this easing out because from one side, they will get more projects to coming in, and from the other side, the overall construction activity in the country will pick up. And this also will trickle down to smaller players and other supporting industries as well, like for example, the materials, the Tokyo and the tile sector and all these. So I think it's a positive that how positive that the government is trying to introduce something like this. But something to note is that this is the first time that is happening in Sri Lanka, and so we may have to wait and see how this is gonna line up in the future.
Right. Thanks, Ranjan, for that insights. Then we have a question on whether the treasury bills are safe, is a safe investment. Can there be a rescheduling of settlement? So something to note is that we've already gone through a domestic debt restructuring, right? So we've completed the process, and the individual investors, corporate banks were not untouched, and it was implemented mostly onto the superannuation funds, and central bank themselves took part of the hit. So I think at the moment it's a very safe investment to be. If you want to talk about the risk side of it, I think now we are mostly going into an external debt restructuring as well, which we will complete that possibly in about a couple of months or possibly end of this month. So once that is completed, our debt to GDP will actually come down below the 100% mark. So which is a positive sign. So I don't think we need to go into another domestic debt restructuring immediately. So if we do really bad over the next 3-4 years, maybe in another 3-4 years, things we may have to reconsider things. But at the moment, the way things are going, the restructuring of SOEs are also progressing. Some sale of SOEs are being targeted. So if that process goes along, I don't see any requirement to do another domestic debt restructuring. So things should move pretty smoothly, I guess. So there's a question on how will the lift of capital gain tax affect investors like us. On the equity side, so let me give Vinodini the opportunity to answer this question. Vinodini, if you do you want to take this up?
Yeah, sure, Dimanta, I'll take it. So the elimination of capital gains tax can enhance investor confidence, and investors might perceive the market as more favorable, which will increase the participation in the market in buying and selling securities. Also, the elimination of this will make investment more attractive to investors, as they will be more inclined to buy and sell assets, which will increase the liquidity in the market as well. Also, without a capital gains tax, investors can get to keep a larger portion of their profits when selling their assets. So this can lead to higher overall returns on investments, and it will also encourage more people to engage in the financial markets. Apart from that, investors may adjust their strategies based on the changes in tax policies. So, for instance, like without capital gains tax, investors might prefer shorter term investments, focusing on opportunities for quick gains. So, the absence of capital gains tax may impact the incentives for long term investments as well. Investors may be more focused on short-term gains without the tax implications, which will potentially affect the stability of certain investments. Yeah.
Okay. Thanks a lot, Vinodhi. So basically, to be clear, currently there is no capital gains tax on equity, which is a very positive thing. In terms of debt side, there is a capital gains tax, but limited to only 10%. However, interest income will be taxed according to the slabs that you are in. So yeah, let's go into the next question. Yeah, it's about yeah. So there were talks on taxing PD companies. Is it going to come during the process of budget getting approval, or is it totally out? Ranjan, you want to take that up?
Yes. Yeah, like the question states, there are a lot of fahu in the market during the last few weeks with the budget coming up and the president hinting that there will be a capital gain tax on the PDs as well as capital gain tax on the trading gains from the trading investments. So this would include both PDs and banks. But from yesterday, what we didn't hear anything regarding capital gain tax on either of those industries. So this is a very positive for the both the stock market as well as the debt markets, because on the stock market wise, we saw the banks and the PDs. There was a big sell-off during the last few weeks, and banks are almost trading at about 0.4 times, while in terms of book value, while the PDs were trading at about 4 times PE. That are very low Ps for this market in terms of even the expected performance that will be coming in the coming months as well. So with this, the uncertainty regarding the capital gain tax has been lifted, and we believe that there's given with the favorable outlook that are coming to both the banking sector as well as the PDs, we believe the shares should re-rate and trade upward from the current trading multiples. And overall, it's a positive that the capital gain tax was avoided from avoided imposing on these PDs and the banks.
Thanks, Ranjan. So there's a question on the rupee. So let me take that up. With these proposals, there will be pressure on LKR to depreciate. Can you please elaborate on those implications? So it's like this now. Yes, if you look at the budget, there seems to be a lot of proposals trying to revive the economy. And so what you need to understand is Sri Lanka is actually a net importing country if you take the trade balance, right? So with that kind of a situation, if we are whenever there is a push towards reviving the country, increasing business activity, so there will be a lot more imports coming in. Obviously, we are relaxing import restrictions. So with that, there could be a bit of a pressure on the rupee. Of course, currently the rupee is trading within a target range, so it's currently closer towards the 327, 330 mark. So we are targeting 320 to 360 up to next June. So obviously expecting the rupee to slightly depreciate with the recovery in the economy. So currently over the next couple of months, of course, we will see a lot more export earnings coming, especially from tourism. So dollar income may come in, which may keep the dollar stable. But of course, beyond that, there could be a bit more depreciation that comes in. So that is natural. And over the last 30 years, we've seen a 5% depreciation in the rupee. And that is something you should export from a country such as Sri Lanka, where we are a net importer. Yeah, so we have a question on the I think there were some proposals, Vinodini, on the dairy side. You may want to remind the investors about that. They're talking about the proposals on the dairy sector and what exactly they are and what the impact and timeline of them are. If you can remind the investors on the exact proposals.
Sure, Dimanta. So according to the question, it is said that their aim is to increase this up to 75,000 liters of milk from 50,000 liters, if I'm not mistaken. So this is apparently a 50% increase, and the government has proposed to implement a special program to increase milk production by 53% in 5 years, by 2028, I guess, with a contribution of the private sector by effectively using all the farms owned by the National Livestock Development Board. Also, they have proposed to implement a refinance loan scheme to meet the financial needs of those engaged in the dairy value chain. So this proposed initiative to increase milk production by 53% in 5 years and to implement a refinance loan scheme in the dairy sector, it can have like several impacts. So this can, so the increase in milk production will contribute to the overall agricultural output and can also potentially boost economic growth, which can become a significant contribution to the country's GDP. Also, efficient use of the NLDB farms, the National Livestock Development Board farms. It will help to is a really strategic approach to leverage the existing resources for the benefit of the dairy sector. So it is can lead to like optimal utilization of infrastructure and land, and also the refinance loan scheme. It will address it will provide like financial support to farmers,
Yeah.
processors, and other stakeholders. It will also facilitate the smooth functioning of the dairy industry.
Correct, correct. So if you're like looking at expanding the production of the dairy as suggested here, I think the refinance loan scheme is where you may benefit from this budget. That there's no specific date when they are going to sort of implement it, but that's possibly where basically that can come up. Right. Okay. So a few more questions. Why Sri Lanka needs IMF funding when foreign remittances by far exceeds the IMF funding? It may be a dumb question, but I am not a financial expert. So this is a question that has come up, but what the question is asking, it's a very valid question. Now, how you take all this into account is, now all this impacts foreign reserves. Now, that's how we need to look at it. Now, our trade balance, that is goods export minus goods import is a negative, right? So we are at a trade deficit there, right? However, there is a lot of other things that get added. So once we add the tourism earnings that comes in, and then the net earnings after you deduct what goes out, then what the worker remittances, we are actually on a balance of payments positive. That's why you saw over the last from January to let's say August or so, central bank being able to increase the foreign reserves, right? So basically, because the balance of payment became positive, on top of what I explained, there was net foreign inflow also that came into government bonds. So it became a sizable amount in terms of the balance of payments surplus, right? So with that, then with that surplus, central bank started buying dollars. Partly it will prevent the appreciation as well. However, since there was a large inflow, the currency also appreciated after buying dollars as well. So with that, what happened? We managed to raise foreign reserves to about $3.5 billion as at now. However, beyond August, or from August onwards, what has happened is we started paying some of the short-term debt. So we settled part of the Indian swap arrangement. We settled the Bangladesh swap arrangement in full. In addition to that, from January onwards, we've been settling the loans that were from the multilateral agency. You can't stop paying those loans. So those loans were being paid roughly amounts to around 150 to 200 million dollars a month, right? So with this situation, the balance of payments is going at a or you could say last couple of months has not been that great. That's why we've seen the foreign reserves fall from around 3.7 billion to around 3.5 billion. right? So foreign reserves with the foreign remittances, only the balance of payments is already calculated. So all those things added together, we get a very small surplus at the moment, right? So that's why we can keep the foreign reserves at the current level. So we believe that it can slightly increase over the next couple of months, because there could be a surge in, on one side, there's a surge in worker remittances, and because of the festive season, and on the other side, there could be a surge because of the tourist arrivals coming in, tourism earnings. So with that, we may have a sizable surplus, especially in the months of November, December, January, that period where if the central bank uses the surplus to buy dollars, can again build foreign reserves. So that's how the structure of the foreign reserves and the balance of payment surplus is. Right. Okay. Okay, there's one final question. There's a request to allow vehicle import that may help to collect 450 billion customs duty, helping government. But how that will play into the pressure of the rupee, considering all payments of the loan in the near future. Also, that may trigger inflation too. Ranjan, you want to take that up? So it's about allowing vehicle imports on one side, which can bring in more revenue. Then on the other side, will it have pressure on the rupee? Sort of, it's about balancing, I guess. So, would you like to answer that question?
Yeah, yes. So yes, as the question correctly states, the government is looking at reopening the imports, vehicle imports, within the next 12 months. And as stated on the question, it will also add a pressure on the currency. But something to look at is that yes, the government will allow vehicle imports, but at what excise duty, what custom duties? Because what we are thinking right now is even if the government look to allow imports and lift the import ban on vehicles, the government will look to increase the custom duties so that the demand won't overheat in the economy. So, and it will not have an impact on the and the government can and the central bank can balance out the impact that is coming to the currency as well. So the main reason that they are looking to the import ban is to increase the money that is being collected by the customs. So what we saw that because of the limited vehicle imports or the vehicle ban that was there, the custom falling short of their revenue targets. And with the government, with the president consistently pointing out that the custom needs to step up and increase their revenue contributions, we may see vehicle imports being allowed, but at a higher tax rate or something that would limit the demand pressure that would be coming into the market all of a sudden, because we have not seen vehicle imports from, as I can remember, from 2020. So there's a lot of there is a certain amount of demand that has already built up in the system. So this may so the government look to control imports through the duties indirectly, so that that the impact would be less to the economy and the currency side. Yeah, so that's our belief is the overall impact. Anything to add, Dimanda, on that?
Yes, yes. So I'll add a bit on to that. So as Ranjan said, obviously there is a lot of pent-up demand already in the system. So of course, the government may not just open up the system so that everybody starts importing cars, definitely there is a high likelihood that they may increase the taxation to have some control as to the demand. Also, on the other side, I think there is a natural control as well with the currency. So, as you know, we have now the currency is floated. So, you need to find your own dollars to import goods, right? So, when you're doing that, if there's a lot of demand for dollars, you may see the rupee automatically starting to depreciate, and that will make the imported item prices, be it vehicles or any other item prices expensive, so that the demand is naturally controlled. Right. So definitely at the start, they will there high likelihood that they will increase taxes and then open up so that there is no sudden surge. And then second control mechanism will be the floated currency, where you have a natural control with the currency being naturally depreciating if there is excess demand. Okay, we can go to the final question for the evening. I think it's whether will bond rates come down further. So basically, it's a tricky question. It depends on whether we can complete the external debt restructuring. Look at the government or the IMF conditions. They want the debt sustainability, which means we have to complete the debt restructuring process, especially the external debt restructuring. Secondly, we need to do some we need to have significant progress on state-owned enterprises front, where some restructuring needs to be done. And on the thirdly, I think we've done a lot of progress there, where implementing certain areas where we can broad base the taxation. So I think on that front, things have been done. So with that, if we think that if the external debt restructuring is completed, as we saw after the domestic debt restructuring get completed, we believe with the confidence factor, there is a natural easing of rates, which is obviously favorable towards the government as well. That is to limit the budget deficit, because it does affect their budget deficit as well. That's why bringing down rates is a very important factor. Okay, we have just received one last question. It's on the banking sector. So with that, I think we can close the session. I will put it on to Ranjan, if you can answer this question. How will the banking sector be performed in the next year?
Yes, yeah. So we are very bullish on the banking sector at First Capital, because we believe that the banks has not gained enough and is yet to reach more potential. Few of the factors that may contribute it reaching the potential is that the expansion in the economic activity that we are expecting for the last quarter, starting from the last quarter and trickling down to next year. And so with the economic activity picking up, of course, the private sector credit growth will start to trickle in as well. And we have already seen substantial growth there, substantial pickup in private sector credit growth. And it has recorded positive growth for the fourth consecutive month. And so with all this happening, that with the increase in activity, the overall banking system will have a small pump with the loan book expansion and the increase in activity. Also, something note is that also the fee side, because the banks, if you look at the banks, one of the main incomes that they're earning is the fee and commission incomes. So with the overall pickup in activity, together with the increase in digitalization digitalization initiative that the banks have taken, there will be a lot of cost savings as well as new digital revenue streams that are coming to the bank. So with this, this will also help banks perform very well and their bottom lines to increase as well. And something on the last point, what we're thinking is from the impairment side. So last year we saw that impairments picking up and recording the highest levels in the banking sector during the past few years. And if you look at the NPLs, those have touched around 13.3%, one of the highest in the last few decades. And this is mainly coming from the contraction in economic activity and the decline in the construction and the tourism sectors. But now we are seeing higher tourist arrivals to the country again, and with that, the burden on the tourism sector to perform well has been lifted. And we are already seeing companies, the tourism companies reaching occupancies past 60%. So this is a very positive development of tourism sector, and with this, we are expecting that the outstanding moratoriums that will be expired within this year will be the companies will be able to pay them back. So there's going to be a reduction in impairments coming on that side, as well as we have also seen government making a few settling up a few outstanding loans that are due to the construction sector through bonds. And so these are few positive developments and that are expected to reduce impairment in the coming quarters, improving the profitability of the banks. And again, finally touching upon the valuations, the banks are currently trading at about 0.4 times. And as I stated before, few of the external conditions, such as the room of a capital gain tax on the trading operations, as well as uncertainty regarding the external debt restructuring, has held the banking sector shares to underperform during the past few weeks. But partly with the cloud being the dark cloud of capital gain tax being lifted from the investor minds, we will see banking sector performing exceptionally well. And if you look at the multiples, which are currently at about 0.4 times, we will see them re-rating about 0.8 to 1 times, given the bank size. So we may see the big three, the big four actually now, with Commercial, Sampath, HNB, and NTB, moving across 1 times book value threshold, while other banks such as NDB and Ceylon will they will see the shares trading slightly at below the par of other banks, but trading at somewhere around 0.8 times book value in the next year. So we continue to remain very bullish on the banking sector, and we are going with a buy on the banks these days.
Okay. Thanks a lot, Ranjan. So in the meantime, we have received another question. So before concluding proceedings and handing over, I will answer this question. What will be the progress in the stock market in the coming year? So we've explained the factor that we're expecting interest rates to come down. In fact, we're expecting a drastic decline in interest rates to somewhere around 10 to 11%, especially the 1 year. So with that, that's about another 350 basis point drop. So with that, what we expect is a significant transfer of funds towards the equity market. So we already saw that a couple of months ago, just before the delay in the second tranche of the IMF, and with it we saw the rates move back up, so immediately stopping the fund flow into the equity market. So with the rates coming down significantly, obviously we are expecting rates to we are expecting the stock market to perform and inflows to come back into the equity market, and with it we are expecting a sort of a bull run in the equity market, with rates coming down as low as 10%. So our target remains as 12,000 for the end of the year. We almost reached it about 1.5 months ago, where the index reached about 11,800 levels. But then has moved down since with the delay of the second tranche. But once we get things sorted out, we still maintain our targets, 12,000 for this year and 15,000 for next year. So with that, what we'll do is we've actually run out of time. I would like to hand over proceedings back to Saima, and there is a couple of more questions that have come along. So what we'll do is we'll answer them by email. Over to you, Saima.
So as we conclude the Q&A session, it's time to wrap up our webinar. A big thank you to Dimanta, Ranjan, and Vinodini for sharing their insights. We believe this webinar has cleared any uncertainties that were surrounding around the budget, and we have addressed all your questions. Thank you everyone for being a part of this discussion, and we wish you all a great day ahead. Thank you.